Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be doing a brief stock analysis on Apple, ticker symbol AAPL. And I actually did a video on this one a little bit more than a year ago, but I wanted to make an updated video going over the fiscal year 2021 financial results, which we're actually going to hop into right now. Definitely, obviously going to talk about some other things, but that will be the main focus of the video. So net sales for the full year, which their fiscal year ends at the end of September 2021. So net sales for the full year was around $375 billion compared to $274 billion last year in 2020 and $260 billion in 2019. So definitely a nice increase there. And their gross margin ended up being around $152 billion, which was up about 50% from the $104 billion last year and the $98 billion the year before. And if we come down here, there was obviously operating expenses and then income taxes. So net income ended up being about $95 billion for the company, which is pretty astounding. Almost $100 billion in net income, which most companies don't even come near that. But around $95 billion for Apple, and that was up from about $57 billion last year. So really a ginormous increase in the net income, and it was about $55 billion in 2019. So in terms of revenues and net incomes, definitely some awesome increases there. We also are going to take a look at the balance sheet here. Current assets are sitting around $134 billion with about $35 billion in cash, which is down a little bit. And current assets as a whole are down a little bit from last year, 2020. But total assets sitting around $351 billion, which is definitely up from the $323 billion that they were at last year. Current liabilities are at around $125 billion, which is a little bit lower than the $134 billion of current assets. So that's awesome to see that they have enough current assets to cover all those current liabilities. And then total liabilities are around $287 billion. And right now, they have about $109 billion of long-term debt, and I think they had about maybe $16 billion of short-term debt. It says here about $10 billion of short-term debt at the moment. So that's about $120 billion of debt. And if we want to, obviously they could pay off, $35 billion of debt right now with their cash. So that really puts their net debt at about $85 billion. So honestly, for a company of this size, $85 billion in general seems like a lot, but for a company of this size, that's really not that much debt at all. And I think they're in a great position financially with their balance sheet to move forward. And obviously, they are spending money and taking on debt so that they can invest into their company and, develop new products. They do have a variety of products like the iPhone, obviously, iPad, the computers, both desktop and laptop. Those are very popular at colleges. I know a lot of people have, the Macs laptops. I forget honestly what they're called because I'm not a fan of them. I don't use them just because most engineering classes use Windows softwares for the most part. So most people in engineering have Windows computers, but most people who are, business students or, not engineering students, a lot of science students maybe as well, they will have Apple computers, and those are really popular in high school or in colleges. I think one of the big reasons is because they're pretty small and light and cheap generally. So that's a big factor that attracts people to their computers. But the other part of their business that is really increasing and sort of a new part of their business, I guess, would be like the wearables, like the watches, the AirPods, those types of things. Obviously, they have the Apple TV, and they are producing like original content on their Apple TV services, and they have some like workout services, like software as a service, like health and fitness type stuff, which is good as well. So really branching out into other areas. Not just focusing on the iPhone. Obviously iPhone does make up a huge portion of their business, But they are definitely branching out, which is good to see. We're also going to take a look at the dividends here, since it is a dividend paying stock in my portfolio. Their annual payout right now is only around 88 cents, which is in a current yield of around 0.5%, which is very, very low, but they have been growing the dividend at a rate of about 9% per year for the last 5 years, and they've been growing that dividend consistently for the past 9 years. Obviously, that's a pretty short time compared to some companies, but for a tech company, that's pretty much expected. And I think over the long term, they'll continue growing that dividend. And we can see as well the payout ratio only at 15%. So they have so much room to grow that dividend. They can grow it a ton right now. And the crazy thing is, even with only the yield of 0.5%, I think Apple's dividends are like $14 billion annually, which is probably in the top 5 or 10%, or probably top 5 or 10 total companies, in the world, highest amounts that they pay in dividends. So that's kind of cool. We're going to move on a little bit towards valuation, and we're going to look at a few different methods here for valuing the stock. The first one here would be the PE ratio. So we're just going to kind of compare the current PE ratio to where it has been historically. So you can see back around 2010 to 2018, their PE ratio was, in this 11 to 15 range, I would say, getting up near 16 or 18, but it was consistently in that range below 20. Could at least say below 20. And since then, it's kind of increased a little bit up into the 20, 25, 30 range. And now the PE ratio is sitting at 30.66, which is definitely significantly higher than it has been historically. But we can also see the last 4 or 5 quarters, they have really grown earnings very rapidly. They have definitely grown earnings at a very consistent pace. And this earnings growth over the past 10 or 15 years has been by no means slow, but over the past few quarters, they really accelerated that growth, which is good to see. And it kind of is corresponding to an acceleration in the growth of the stock price as well. So overall, they're definitely a little bit overvalued in terms of the PE ratio and comparing them to their historical values. But we can also look at the PE ratio in comparison to their sector. They're definitely in this hardware sector hardware industry in the information technology sector. So the overall sector has an average of 30.46, which is pretty much right in line with where Apple is, but the actual hardware sector, they have a PE ratio of 22.63, which Apple is significantly higher than. So compared to the sector, they're really not that much overvalued. But you could argue that that doesn't really matter because the sector is just overvalued compared to the market as a whole, which is probably true. So PE ratio wise doesn't paint a great picture for Apple's valuation. Some people would argue, they're just a premier company, so their valuation is just going to be inherently high, which is not a terrible argument. That's definitely true. They are a very high quality company, but that's not really an excuse, I guess, to buy it at a bad price. So I also did a short DCF calculation here, basically looking at the free cash flows and projecting them out. I used analyst estimates for revenue, and then I compared that to net income and free cash flow and basically predicted the net income and free cash flow off of that revenue projections based on historical values as well. So these right here are our free cash flow projections going out the next few years, and then these are the present values of those free cash flows based on our required rate of return, which is 7.5%. This is just an arbitrary value I picked. Obviously, you could do a weighted average cost of capital calculation as well, but sometimes that does or doesn't make a whole lot of sense to use that, I think. So in this case, I just used the 7.5%, and it comes out with a fair value of around $134 per share. The present value of current free cash flow is around $2.2 trillion, and when we subtract their net debt of around 89 billion, we get to about $2.199 trillion of the present value of the free cash flow. And if we divide that by the shares outstanding of around $16.4 billion, we get to 16.4 billion shares, we get to a fair value of $134 per share. And if we add on a little margin of safety of 10%, that gets us to a buy price of $120 per share. And the current price is $172 per share, which would indicate that Apple is pretty drastically overvalued. If we did a quick calculation here, to see how much overvalued it is, we could see that it's about 42% overvalued. And another way of looking at that would be to say that it needs to drop by about 30% in order for us to want to buy that stock. So this number right here is saying it would have to drop, the stock would have to drop by about 30% before it's deemed a buy by this calculation and this margin of safety. And that means, this number means the current stock price is about 43% above the buy price. So that is another way of looking at the valuation. The PE ratio and discounted cash flow, those are kind of, fundamental analysis based on their business. And another way we can look at the stock price is on a technical level by looking at a chart. So this is the chart going back 1 year. It's the 1 year, 1 day chart. And the first thing we can look at super easily is the RSI, which right now is around 49, which is pretty much right in the middle. You can see the last few days they've had a pretty big drawdown, not pretty big, but pretty red candles there that are kind of big. So right now, like I said, RSI is around 50, and the volume, it has been pretty consistent over the last year, nothing crazy going on there. But if we look at this volume profile over here, we can see over the last year, most of the volume is between this, 113 and 155 level. I think that's 70% of the volume between these two yellow lines. So that means 70% of the volume is basically between $113 and $155, which that may not be entirely correct. Yeah, that's 122 and 148. For some reason, these don't line up quite right, because the low is 116. So if it was, if the volume 70% was above 113, that would make sense if the low was at 116. So the low over the past year was 116. And that means that most of the year, compared to our fair value calculation, Apple has been overvalued. I think our fair value is around 134. So that's right around this level here. So most of the time it's been overvalued. I guess the first half of the year it was, seemed a little bit undervalued for most of the year. But this second half of the year, it's really taken off. And if we look from a technical perspective, it definitely looks a little bit overextended as well. You can see there's really not that much volume up in these price levels supporting this extended price. And we can see there's actually the most volume ever is around $150 per share. And above that, there's really not that much volume at all. So honestly, if we see some more drops in the stock price, I would not be very surprised at all if the stock dropped all the way to around $150 per share again, because there's a lot of volume there, and the price tends to settle around these areas where there's the most volume. So that's just something to consider from a technical level. It looks a decent bit overextended as well, but I would say, Apple, obviously, like we've said before, is a super high quality company. So there's, not really a terrible time to be buying, in my opinion. Obviously, it's definitely overvalued right now, but you have to consider, do I want to own this company? And sometimes it's best just to buy a little bit here and there, and then, when you see a really good price, buy a lot more. For me, that's definitely not what I'm doing with Apple. I haven't really bought much Apple in a while, and I'll definitely be looking for something at least below the 150 level, closer to the 130s or 140s would be awesome for sure. And I definitely wish that I bought more towards the beginning of the year when it was around that between like 120 and 130 for a while. I was definitely hoping it would go a lot closer to 100, like 110 or so. Then I was really going to jump on it, but it never really got that low. So that's definitely a missed opportunity for me. I really wish I did buy a little bit more there, but let me know what you guys think of Apple. It's obviously a super popular company since it is the most valuable company on the stock market, but I do like it a lot, and like I said, I would love to see it under 150, 140, and I would be buying more there. So let me know your thoughts in the comments down below. I want to thank you guys for sticking around to the end of the video, and I will see you in the next one.